There are a lot of people out there who say we're on the verge of a financial meltdown. They say that houses and all assets are overvalued. They've become detached from the fundamentals. And only a major economic downturn can return those values to where they should be. Now, I think that's a little extreme, especially when you consider some of the things that have been happening over the last several years. But there might be something to it, especially when you consider things like the national debt. I don't have a crystal ball to predict what the future holds. But I do know if you're thinking about buying a house, and you buy into this gloom and doom forecast, that it's very unlikely you're going to buy anything now because you could be very cautious and you're going to want to wait to see how things play out. So let's look at it both ways. Let's consider what would happen if they're right and what would happen if they're wrong. So if they're right and a crash does happen, what would that look like? Well, if you already own the asset, the only thing that would change is the potential value. I call it potential because you wouldn't realize that loss until you sold the asset. Let me give you an example. If you own $10,000 worth of Tesla stock and the value decreased by 50%, that means your stock would then be worth $5,000. Now, unless you really needed that money, you probably wouldn't sell it. Well, it's the same thing with houses. If you think your house is worth $800,000 because of the crazy money that was spent during the pandemic housing boom, but comparable houses in your neighborhood are currently selling for $400,000, you could either sell it for what the market says it's worth, or you could hold on to it. Of course, one big difference between owning a house and other types of assets, such as stocks, if you decide to hold on to the house, there's going to be costs associated with that. You would still need to cut the lawn, pay the HOA dues, pay the homeowner's insurance, and the big one is pay the property taxes. Now, another difference between a house and other types of assets is that you probably have a loan on it. If you bought $10,000 worth of stock, you would need $10,000 in cash to make the purchase. But if you bought a house with a mortgage, you would need the total amount in cash. This will accelerate your return if the house appreciates in value, but it will also accelerate your loss if the value moves the other way. Let me show you. If you put 25% down on a $400,000 house, you would have a mortgage of $300,000. If the value of the house appreciates 25%, the return on your money, that down payment, would be 100%. But if the value of the house decreased by 25%, the value of your $100,000 down payment drops to zero. Because if you sold the house, you're going to have to pay off that mortgage before you see anything. Now, the final difference between a house and other types of assets is that a house can produce income. If you chose not to sell the house, you might be able to collect enough in rent to cover all the other holding costs. But that's only if you have somewhere else to live. Because regardless of what you choose to do with the house, you're still going to have to pay for housing one way or another. Now let's consider what would happen if you chose to wait to make the purchase of the house until after the market crashed. If there were an economic downturn, we would probably see a reduction in home prices. But it would become more difficult to borrow money because every time there's a downturn in the housing market, credit gets tight and lending becomes much more restrictive. In other words, you can't have it both ways. We saw this play out over the last several years. When interest rates were low, people spent more. But when interest rates went up, they couldn't afford as much, so guess what? Home prices went down. And this is the primary reason that I don't buy into this crash is coming hype. If you are still hoping for a crash, I hate to break it to you, but you may have already missed it. Which brings us to the final consideration. What if all these predictions about a housing crash or an economic downturn are all wrong? Let's go back in time and see how this theory has evolved. When interest rates started to rise, the economists and all of the market gurus predicted that we were going to go into a recession within 6 months. When that didn't happen, and the jobs reports came in stronger than expected, and corporate earnings were higher than expected, and inflation remained higher than the 2% target, most of those same economists and market gurus started talking about that the economy wasn't as strong as it looked. And since everybody is now expecting a soft landing, that's a sure sign that a crash is coming because that's what happened in 2008. Come on, let's get real. If you were to predict a recession every year for 10 years straight, you're going to be right at least one of those years. But other than historical graphs that show that recessions do happen and that median values of homes and interest rates and pretty much everything else fluctuates, other than that, what do you propose is going to happen that's going to cause this economic downturn? If we look at the last 2 years and recognize that home values have declined from their pandemic housing boom peaks. In fact, in some areas of the Austin Metro, home prices are about where they were before the housing boom began in the first place. If the pandemic housing boom was the peak, and this is the valley, what do those same historical charts show comes next? Let me wrap this up by saying this. If you're thinking about buying a house and you're concerned about what the market is going to look like in the next year, you probably have the wrong mindset. Here's an example for you. If you would have bought $1,000 worth of Apple stock in 1997, that stock would be worth $1.3 million today. Another example is if you would have bought a house in Central Austin around that same time period, you would probably have seen that value appreciate anywhere between 5 and 10 times what you paid for it in 1997. And if you were to calculate your return off of your initial down payment, that return would be pretty close to what you saw in that Apple stock. And these types of gains happened in spite of all the economic ups and downs over the last 27 years. If you like this video, you should check out this other one I did on the Austin housing market. And don't forget to subscribe to my channel and ring the bell. That way you'll get notification every time I post a new video.